moment now. So the expectation is that this time around, profits could see quite a boost. In fact, we're expecting a 10% growth on the bottom line to close to about the 950 crore mark. Our exact expectation is 944 crores. On the top line as well, there is an expectation that revenues could grow about 10% and come at about 23,400 odd crores. Margins are expected to see a 40 basis point improvement as well to upwards of 11%. EBITDA too could move up. So let's see how things move. I think any moment now we should be getting the numbers. Elsewhere as well, it is the expectation is that it's going to be a stable quarter this time around. There's a pickup in revenue growth, like I said, and that's because of execution of some of the large domestic as well as international orders that the company has seen. But let me not hijack all the expectations. We have Varinder also with us, who's been tracking this stock. Varinder, what are you expecting and what will make the street happy?
Well, good to stable set of numbers expected from L&T this point of time. On a consolidated basis, street is expecting that there will be growth of nearly 10.5%, EBITDA up by nearly 14%, margins to increase by nearly 40 basis points. In L&T, it's very, very simple. You got to watch out for execution, the domestic and the international orders, which will tell you how the top line has behaved. So if the execution has been good, you will see the top line growth of that 10.5%, what the street is expecting. And the second, in terms of segmental results, of course, the infra segment, which is nearly 40% of the revenues, will be the key segment to watch out for. In last quarter, there was a growth of nearly 11%. So keep an eye on that. Hydrocarbon, which has been a drag on the company's performance, but only last quarter there was an EBIT positive in that hydrocarbon segment. So watch out for that. The third most important thing to watch out will be the order book. Yeah. Most of the analysts of the street are expecting that the order inflow this quarter, that is quarter 2, will be nearly 30,000 crore. If you have to just club what the announcements has been done till now, it's nearly 12,000 crore. So keep an eye on that number, because we haven't seen good performances coming from other, infra or cap good companies. So that 30,000 crore number could be important. And of course, the last one is the guidance mark. Remember, the company has told us that for FY16, order inflow guidance remains that 15%. So whether they stick to that or not, that could be important to watch out for. And of course, they have also told that there could be 100 basis expansion in terms of margins in FY16. So that could also be important.
All right. I think the numbers are just getting uploaded on the exchange currently. So we're waiting by just trying to open it.
Yes.
I think the numbers, all right, we're still waiting by for those numbers. The stock, though, hasn't moved too much, so.
Okay, let's see. Consolidated gross revenue of 23,605 crores. And the profit has come in at
996.
996. Okay, so 996 is actually better than what we were expecting. Our poll had thrown up a number of 944, and 996 should make the street very, very happy. Varinder, what more can you tell us?
I'm just opening the press release, okay? But the two numbers, what you said, the numbers are looking good. But, let's see the internals, I think, before even making any statement.
Yeah, so 23,605 on the top line should easily be a growth in excess of 10%. It should be about 12-13% over there. Profits too would be in double digits. So I think both these numbers for now
the company
are keeping the stock
secured fresh orders worth 28,620 at the group level during the quarter. So that's something that Varinder was looking for. And the international order inflow during the quarter came in at 10,973 crores. That constituted around 38% of the total order inflow. So those are a couple of numbers that we are looking forward to as well. And the consolidated order book at the group level stands at around 2,44,097 crore as of September 30th. So these numbers as well in terms of the order book, that they should be up for you on the screen. And it's higher by around 14% on a year-on-year basis, with international order book constituting around 28%.
More details in the infra segment that Varinder was talking about earlier. They have a revenue of 10,668 crores, which is a YOY growth of about 11%.
The EBITDA margins are at 2,590 crore, okay, or 2,592 crore to be precise. If that is the number I am getting, if that is a thing, it's lower than what street was expecting on the EBITDA front. As you said, the top line.
I think we should watch by for an exceptional gain as well. There's an exceptional gain of around 310 crores. Our ticker team has just alerted that. So it's a consolidated net profit at around 996, and if that 300 crores is part of that number, then in fact it'll be sharply lower than what we were
then I guess it's a bit numbers.
Oh, right,
correct,
that's when the stock is coming off. Just take a look at that. The profitability is at around 996 crores, and there's an exceptional gain of around 300 crores. Piyush Jain joins us currently. Piyush, the numbers are flashing for us on the screen. Margins at around 11.5%. Top line is a tad bit better, but bottom line has been boosted by that other income of around 300 crores. How are you reading the numbers?
I think, first of all, the core numbers appear to be weaker than what we were thinking. So I've still not been able to calculate the EBITDA margins. But overall, if I look at the segmental performance, I'm clearly seeing that there is a loss in the heavy engineering segment, there is a loss in the hydrocarbon segment.
Yes.
So I think that is clearly pulling down the entire group profit. Core group net profit is below than our expectations. Lower order inflow was anyways expected. So while I'm expecting that now the full year guidance will be very tough to meet, but I'm not that concerned at present with the order inflow, because the order backlog is like giving more than 2 years of revenue visibility. What my really concern is that what is happening in the segments. Within the segments, it is clearly showing that there is a poor operating leverage, and perhaps the cost overrun is still continuing in the hydrocarbon segment. So I think that is really pulling down the core performance.
Even if you just see the infra, which is nearly 45% of the total revenue, the EBIT margin for the infra division has come at 6.6% compared to 8.5%.
Yeah.
So it's nearly 200 basis point dip in terms of the EBIT for the infra division, which has come in. So if you look at the infra revenue, they have gone up by nearly 13%, but the EBIT actually has dropped, which is not a good sign.
Right.
It has come at 735 crores compared to 832 crores, which clearly means that the EBIT has dropped by nearly 200 basis point in the in the infra segment.
All right, then I think the street is not liking these numbers because the stock has come off close to around 2% from the top. So let's get another opinion. We have Pankaj Sharma who joins us currently. Pankaj, what's your take on the numbers? There was a bit of a devil in the bottom line, boosted by that big other income, but otherwise segmental performance, how are you reading it? It's a bit disappointing?
Yeah, it is disappointing, and more than what they have done in second quarter in terms of top line and bottom line, which has been boosted by exceptional. I think the order info number is also not looking good, because if you look at what they have guided for is almost a 15% kind of order inflow growth in this year, and I think it is going to be very, very difficult to reach that kind of number. So either there is a possibility of reducing that guidance or missing that. So I think that's not good.
Nigel, one point, the heavy engineering division has done very poorly this point of time. The revenues are down 25%, but look at this, there's an EBIT loss of 140 crores for the heavy engineering division, this time, compared to a profit of nearly 77 crores last year. And on a sequential basis also there was a loss of 4 crores.
Only 4 crores.
But this time 140 crore of loss coming only in the heavy engineering division. I don't think this is a good sign at all. Apart from, I can't see any growth coming in. Infra has seen a growth in terms of revenues. The metallurgical and material handling segment has seen a decline of nearly 17% in terms of its revenue and a decline of nearly 80% in terms of its EBIT. Right. But I think the biggest hit is clearly coming in the heavy engineering business or division.
And it contributes only 650 crores, I think, to the revenue, and on that we're getting a cut of around 140 crores. So that as well appears to be a bit of a disappointment. But we have Mayuresh as well. Mayuresh, let's get in your first take on L&T's numbers. The stock has corrected a good 3% in the last 10 minutes.
So yes, I think a tad bit disappointing when it probably comes on the operational front. And again, I think in terms of the consolidated order book, I think it will be difficult for L&T if they run at this run rate over the next few quarters to give or maintain its guidance of 15% that they had started the year off with. Having said that, I think the heavy engineering has seen a huge hit, and again, I think what probably happens in terms of execution, both on the domestic order flows, is a key monitorable for the company. So the E&C execution is something to be watched out for, both in terms of a muted performance, which looks like from the operational side on the domestic projects. And again, I think the order wins of probably overseas because of fall in crude prices have seen a large bit of disappointment.
Sharmila, what about you? What was the target that you had on L&T, and would you look at revising it lower now?
See, a lot of, in terms of stock price, it really hasn't done anything much. So perhaps in terms of that, I wouldn't expect a very big fall in L&T. But I think the concerns, I mean, as they've been voiced by everybody, I think also the key thing that you need to understand from the management or from the numbers going ahead is at what price point are they closing orders in terms of the larger infra orders in comparison with their cost. Because I think clearly that operating leverage pressure is seen very clearly in these numbers. And I think an even bigger takeaway is that if this is considered BHEL and L&T would be really considered the largest companies within that space in the Indian context. And if these are the kind of numbers that, especially on the operating leverage side that they are reporting, then it clearly shows what kind of pain that entire sector is going through, and that there really doesn't seem to be too much, sort of positive to take away from that environment.
All right, I think we can also go across and hear out the management who I think have begun speaking.
A brief presentation to you on the results. And for the Q&A, we'll be joined by Mr. S. N. Subramanian, Deputy Managing Director and President of Larsen & Toubro. So may I request Mr. Shankaraman to start off.
So good afternoon to you. Thank you for sparing your time this afternoon to be with us in the media briefing on the results of the company for the second quarter ended 30th September. Two disclaimers before we proceed further with the presentation. One is towards the forward-looking statements that could be made in the course of our conversation. And second is you're sitting in the premises of a company which essentially works on project business, and that too infrastructure project business. And our business does not lend itself to 90-day evaluation of progress as the markets would like. So the numbers that you're going to see on a quarterly updates are not going to be representative of the position at the end of the year. And one quarter is too small a time for us to really turn around project business and much more the infrastructure business. Having said that, let's look at how we have performed between 1st of July 2015 and 30th September. Revenues have gone up by 11% for quarter two, and for the half year it's moved up by 9%. EBITDA margins for the quarter two has moved up by 5 basis points, and for the half year it's down by 88 basis points. This reflects the income that we had from a substantive transaction last year when we divested Dhamra Port, and the profits are embedded in the margins that you see. The profit after tax for the quarter two is up by 16%, and for the same reason of the one-off Dhamra sale, they are down by 12% at the half-year level. Order inflows have been down by 28% for the quarter two and down by 25% for the half-year, reflective of the investment momentum in the economy that we see today. The order book, however, has moved up by 14% both for the quarter two as well as for the half year. To start with, let's look at how the orders have panned out for the company for the quarter. The company has won 286 billion rupees worth of orders in quarter two, which together with the 264 billion rupees worth of orders that it has won on quarter one makes it a total of 550 billion for the half year, April 1st to 30th September. This is down by 25% as compared to 732 billion of the corresponding period previous year. There are a couple of things to bear in mind when we reflect on the way the order inflows are shaping. One is in the previous year there have been both domestically and internationally certain large chunky orders which helped us to clock larger order flow than what we normally do in the first two quarters of the year. You will recall that we are often H2 oriented in terms of orders, and that's the way the project orders play out. In a contrast to that normal trend last year was some big ticket wins both in India in terms of power sector. We won some large orders in the power sector. We also won some defense orders last year, and we won a large international job in Kuwait. All of this were not repetitive in nature, and consequently the order inflow in the current year are devoid of such large wins. The second aspect to the order inflow is, I think it is a fact that the investment momentum in the economy despite a lot of efforts that various stakeholders are putting in, is yet to really pick up. There is excess capacity in most of the sectors, and the private sector are more worried at this point in time about better capacity utilization and profitable utilization of existing capacities than spending their time and energy in trying to add to capacity. So the entire demand momentum has to go up in the system for their capacity to be better utilized, for them to talk about new project orders, and then L&T gets into business. So there is a cycle which has a lead lag, and we are still at the lag end of the cycle. Secondly, thanks to the oil prices staying low, the Middle Eastern projects have got into review mode. It's very important for all of us to appreciate that they've not been as much shelved as they've been taken up for review. Because while it is true that the oil prices are low and hence the economics at the output level is very different as compared to the time that they originally conceived when oil was $100 to a barrel, it is also true that times such as these is the right time to add capacities. So it is a balance between cost of lower capacity and the lower economics at the output end. And we find many of these projects are getting reshaped rather than completely abandoned. But this process would take some time, and hence it would take a little while for companies like us who have engaged with them to revisit the bids and the tenders and start bidding and winning for jobs. So we do think it's a phase that we are passing through, and the company would be able to, as both domestic economy and Middle East gets used to better conditions, we could see a little more robustness in the order inflow. The order book has reached 2,44,000 crores, very significant and pretty large, easily covering the next 8 to 12 quarters of revenue of the company. The domestic slowdown in orders during the current year is perceptible. Consequently, the share of international orders are up 35% in the half year as compared to the previous year, which was about 30%. The order book as well has moved up at 28% of the total order book that we have to be executed on international jobs and 72% on the domestic jobs. Where did the orders come from? Bulk of it came from the infrastructure segment, and that's where the spends are happening today. And much of the spends are also happening courtesy the government trying to push some of the sectors like transportation, power transmission, distribution, and water. The benefit of these spends are reflected in 52% of the orders that the company has won, being in infrastructure sector. The rest of the sectors are really scattered in terms of order inflows. Much of the ordering that has been happening, barring power, where 35,000 crores worth of orders have been tendered out. And it's another matter that we have not been successful in those orders. And it is also another matter that we really do not mind not being successful at the prices at which these orders are being won. But barring power, all the rest of the sectors are investing more in terms of capacity augmentation or maybe beneficiation or productivity enhancements. The investments are of that nature rather than brownfield or greenfield expansion. For sake of completeness, all the revenues that we earn in services business are reflected back as orders, because unless the orders are placed on us, we don't deliver the services. So they account for 19% of the order pie that we've had for the year so far. The order book, following the flow of orders from infrastructure sector, 1,75,000 crores out of 2,44,000 crores are from infrastructure sector, and followed by 23,000 crores worth of orders from power sector, 11,000 from metals, minerals, material handling, and 14,000 from hydrocarbon. The rest of them are reasonably small to merit a separate discussion at this point in time. The performance of the group, the company has earned revenue from its operations at a net level of 233 billion rupees for Q2, which is an 11% increase over the previous year. Of the 233 billion, 76 billion rupees came in from international revenues, which accounts for 33% of the revenue. It's also interesting to note that the growth of international revenues is 19%, whereas the overall revenue growth is 11%, which means that the execution challenges that remain in the domestic projects continue through one more quarter. All the operating costs, the manufacturing, the construction, the staff costs, the selling administration, and the cost of doing the entire operations add up to about 208 billion rupees for the Q2, which is a 10% increase over the 188 billion of Q2 of the previous year. The increase in cost is much lower than the increase in sales, which does benefit the EBITDA to maintain stability. Insofar as the half year is concerned, the net revenues earned by the company at 436 billion rupees is up 9%. The sales from international jobs continue to be similar to the Q2 position at 33% of the overall sales. And for the half year, the international sales have grown by 27%. All of the cost of operations add up to 387 billion rupees, which is a 10% increase over the corresponding period of the previous year. The EBITDA for the company for Q2 has been at 25.92 billion rupees, which is 11% growth over the 23.34 billion of the previous year. For the half year level, it is flattish at 48.82 billion rupees, which is very similar to 48.41 billion rupees of the previous year. The previous year, the H1 of FY15 had the gain from divestment of Dhamra. So consequently, we had the benefit of EBITDA margins of the previous year enjoying the gain, and hence it is at 12.1% as compared to the 11.2% of the current year. Now, the decline in 90 basis points is largely explained by this single transaction, whereas the margin at the quarter level is pretty stable. The interest expenses for the quarter has gone up sharply, largely because we commissioned 3 road projects in one of the subsidiary companies of the company, which is into toll road business. And when you commission projects in a group, the interest expenses, which either was capitalized for the project, comes onto the financial statement. So much of the increase is this. And because it was a quarter where the adjustment is seen, you find a certain sharp increase, but this will pan out over a longer period of time to more normal. The interest rate that the company at the group level is incurring is at about 9.5%, which in today's time and for the sector that we are participating in is pretty competitive. The depreciation increase is also similarly because of the capitalization of these 3 road projects, and hence, apart from the increase in the depreciation because of the Companies Act, the other portion which leads to this increase is this capitalization. Other income has been fairly stable at 2.19 billion rupees, largely reflecting the interest earnings and the dividend earnings of the company. For the profit after tax for the Q2 at 9.96 billion rupees, we are up by 16%, and for the half year we are at 16.02 billion rupees, which is down by 12%. Again, the same reasons of extraordinary income that we had in the previous year. We, as you know, are divided into 10 segments, and namely infrastructure, power, metallurgical, material handling, heavy engineering, electrical automation, hydrocarbon, the developmental projects, information technology, technology services, financial services, and the rest. Now we look at a summary of performance of each of these segments now. Starting with infrastructure sector, the segment revenue for Q2 has been at 106 billion rupees, which is 11% higher than the Q2 of the previous year. And for the half year at 189 billion rupees is up by 13%. The EBITDA margins of this sector for Q2 at 8.5% reflects a 1.5% decline to the previous year's Q2. And for the half year at 9.5% represents a decline of 60 basis points. The decline is largely on account of the status of the jobs and the mix of the jobs. As compared to the H1 or Q2 of the previous year, the percentage of jobs which are waiting to be valued for their margins are larger in this quarter and this half year. Consequently, we have to wait for the jobs to reach their margin recognition threshold before the margins are released in the statement. So it's a point in time situation, and is not reflective of the trend that we see for infrastructure segment as going forward. Insofar as hydrocarbon segment is concerned, the segment revenue is up 7% for the quarter at 19.33 billion rupees, and for the half year it's up 23% at 41.23 billion rupees. As we are executing the jobs that we are having on hand, we are able to see the momentum increase on the revenue side. But what is very important is we need to keep winning jobs to be able to sustain the growth in revenue. So future growth of revenue past the current order book would be reflected and determined more by the order wins that we do. The good news, however, is clients in India are looking at investment in augmenting the energy resources, and low oil prices have also encouraged the mid and downstream people to look at better opportunities to maximize on the refining margins that they currently enjoy. So I think going forward, it does look, once we are out of the difficulty of the challenged projects that we are executing in the Middle East, and we are almost at the completion, the last leg of those, the way ahead looks promising. Looking at power segment, I did mention at the beginning, there have been orders. I think both the public sector units as well as the state utilities, power generation companies have been busy putting out tenders. There's a fair bit of competitive intensity because these orders are available to the market after a while, and hence the price points at which these orders are being won is extremely challenging to the cost structure. Having said that, it is good to be in a position to be able to participate in bids rather than worry about a lack of any investment activity. We do believe that over time we should be able to take advantage of this changing momentum in the power sector. The revenues are up by 21% for the quarter 2, largely because of progress on execution on the jobs that we are currently engaged with. And for the half year, they are up by 17% at 25 billion rupees. The EBITDA margins are up by 3.1% for the quarter 2 at 16.1, and down by 3% at 13.3 for the half year. This classically reflects the volatility in the project business and how misleading it could be if people were to draw linear conclusions out of the margins flow. Materials, minerals and material handling, the entire sector is still stressed. All of us know about the state in which both ferrous and non-ferrous industries are in. With the softening of the commodity prices, we do not see substantial improvement in the near term for this sector. So we are going to maybe see over the next 1 or 2 years some gradual improvement creeping into the sector as people begin to find economic reasons for making investment in this sector. However, the segment revenue at 5.5 billion for quarter 2 and 10.37 billion for H1 does reflect the depleting order book. And if they're not going to be augmented by fresh orders,
and we'll come back to L&T in a minute. Let's just listen into the first words coming in from Apollo Tyres. Numbers seriously disappointing. Nanda Kochhar will also be speaking on her numbers.
Has grown by 16% for the quarter at 18.63 billion, and for the half year at 36.46 billion rupees, it's grown by 18%. The EBITDA margins have improved smartly, largely because of good liability management and containing of the non-performing assets. So the EBITDA margins at 18.1% for the quarter is up 2.4%, and at 16.6% for the half year is up by 1%. Information technology and technology services have done well. On dollar terms, their revenues have grown by 11 to 12%, and aided by the currency movement, the rupee value of the revenue growth is at 23% and 22% respectively for quarter 2 as well as H1. At 22 billion rupees for quarter 2 and 43 billion rupees for H1, the business is on a strong footing. We have the EBITDA margin at 21%, up 2.5% for the quarter, and at 21.1%, up 1.7% for the half year. The efforts that the company is taking in augmenting its business, investing in talent and augmenting its sales force and delivery capabilities, beginning to show some results.
Well, closing bell is not starting on a good note.